Hello friends, this is Vijay Bhambwani and I'm back with you to discuss the markets, and what a week it was. The retail traders finally managed to push the markets above the psychological barrier of 16,000 levels, and it was fairly convincing. And in the following minutes, I'm going to share my exclusive studies which are in-house. You won't find anywhere else on the internet, in the public domain, which is the work of our in-house statistical model, the Barracuda. And I'm going to show you how the markets got fairly excited statistically and whether this upthrust has the legs to go on. Let's dive right in. And coming up on your screen is the market roundup window, which shows that the indices rallied smartly, with the Bank Nifty convincingly not only playing catch up but also outperforming the Nifty 50. Bullion, that is both silver and gold, fell along with oil. Not surprisingly, I would say. By now you know that a strong dollar exerts pressure on hard assets, which is commodity. And falling oil prices eased inflationary concerns, which is good for equities. And the USD INR fell, which means the rupee rose against the dollar, which is another comfort point for equity bulls. The 10-year benchmark bond yield rose to the upper end of the 3-month band, which is a mild concern. We are going to discuss this in a bit. But coming up on your screen now is the MWPL chart, the market-wide position limits. And it shows a rapid rise in open interest, which is routine after expiry. But the momentum of the rally shows eagerness of the bulls to raise their fresh long positions. Now, look at the basis chart. Basis is the premium enjoyed by the futures over cash. It shows the week-on-week gains logged by the Bank Nifty basis because of short covering. Now, this is one prime reason why the Bank Nifty rose so sharply. The bears got squeezed, and this index vaulted higher as compared to the Nifty basis, which fell due to hedging by stock bulls. So whatever long positions they had in stocks, they hedged by shorting the Nifty. On your screen right now is the cumulative volumes chart of the futures, and remember, these are August, September, October futures. And the chart shows falling futures volume, which shows caution at higher levels. Ideally, I would have wanted the price and volumes rising in tandem, but I don't think it's going to be a big buzzkill or a party pooper. So not to worry too much about it right now. We'll take a look at it as time progresses. Stay with me. Connect with me on social media. My contact coordinates will come at the end, at the fag end of this video. But what really excited me into making the exciting thumbnail that I have made for this video is this week's impetus chart. Now, last week I told you that the impetus was falling rapidly, which meant that momentum or the acceleration was easing off. It meant that neither the bulls were buying too much or the bears were selling too much. So the markets were going into hibernation. And obviously a big move would obviously unfold, and that would be noteworthy. Well, here you have it. The markets rose. And how? The impetus is our very own in-house study. You won't find anywhere else on the public domain, like a whole lot of studies that I show in this video. So the market velocity or the impetus bottomed out on Monday. It hit a period high. This impetus chart is for 20 days. It hit period high since then. And the remaining 4 days after Monday saw the impetus leaping up, and trader enthusiasm mount with every day of gains. If you connect with me on social media, you can follow these developments as they unfold late in the evening, which I update on my social media pages. My contact coordinates come at the fag end of the video. Let's now move on to another powerful study which shows what the market players of various types are doing. Let's first start with the FIIs. who reduced their stock futures long positions to 77,595 lots from last week's 89,453 lots. Their index long futures were at 58,635 lots from an earlier week of 35,364 lots, which means their index longs have gone up. The domestic investment institutions, the DIIs, reduced their stock futures shorts. They were heavily short. And from a record high of 12,26,147 lots short, their stock future shorts are reduced to 11,98,262 lots. Their index future shorts now were higher, however, at 62,262 lots from last week's 51,839 lots. So on the index, they are going hedge. Prop traders, who are the smarties? These are specialists, floor traders, brokers, own trades, who know who's buying, who's selling because they are empaneled as registered brokers with many institutions. They raised their index shorts from 2,866 long positions to 16,315 net short positions. Remember, this is just the index. The stock futures longs, however, went up from 1,71,891 lots to 1,86,739 lots. Now, they're expanding their exposure levels, expecting more upsides. Now, let's take a look at retail traders. On the other hand, are playing it cool. They cut their stock futures longs from record highs of 1 million plus to 9,33,928 lots. And the index futures longs went up to 19,940 lots from 8,233 lots last week. Let's now turn to the bond markets, which are the fountain of all money supply and unfortunately one of the most neglected by a vast majority of all traders. But not you, my viewers. The fact that you're staying with me so far in this video shows that you want to understand what really moves the market, how, when, why, and how much. So here's the 10-year benchmark bond yield chart, which shows that the yields have edged to the upper end of the last quarter's range, and it closed at 6.23%, which means bond prices fell. And that gave a mark-to-market loss to banks who are holding these bonds. They are particularly public sector banks. The fact that the RBI preferred to focus on growth rather than target yields showed that inflation may rise and so can coupon rates over a period of time. And I'm holding on to cash rather than deploy this cash immediately in fixed income instruments. Who knows? I might just get higher rates in the coming weeks or maybe a couple of months. Now, the consumer goods funding, that is purchasing on friendly EMIs, might just get more expensive, and about that I have little doubt. Unless the company itself is unloading older model goods onto the buyers. I would advise you to buy on down payment and not take the EMI route. And keep watching the bond yields on a day-to-day basis, especially if you're a bank nifty trader or even banking stocks segment trader, because let no one tell you otherwise. Bond yields move the markets, not the other way around. Friends, let's now go to the US dollar index, which is the US currency's benchmark against the global basket of currencies. And what a roaring comeback it showed. And it rose on 3 out of 5 trading sessions. And Friday surprised forex traders because the US greenback literally roared higher. To those who ignore this instrument, note that everything from bullion, energy, interest rates, and yes, even equities are impacted by the US dollar because it determines the price you will pay at the pump for your fuel, your cell phone prices, and even your electricity bills, either directly or indirectly. Play smart take a 360-degree worldview of the markets and note everything that will impact your costs. Note the price on the daily chart has crossed above the 25-day exponential moving average and it's headed towards the 93.5 level, which I have been talking about for many weeks. Now, if this level is taken out, which means overcome, there could be bear covering or a bear squeeze. On the other hand, if the 91.5 level, which is a litmus test for the bulls, if this level is violated, the bulls are going to be on the ropes for a change. And this could have a very interesting fortnight or so for the market ahead if the Dixie was to make large moves. The weekly chart on your screen shows a bullish piercing pattern, which means the green candle of the last week has pierced the previous week's red candle by more than halfway, and the price respecting the 25-week exponential moving average and rallying from there. Follow-up buying will be needed to propel the Dixie to higher levels. Last week, I advocated a range between 93.25 on the upside and 91.10 on the downside, which held perfectly. And the coming week is likely to see an estimated, I stress the word estimated, range between 93.85 on the upside and 91.75 on the downside. Watch this Dixie keenly in the days ahead. Friends, let's now go to the Bank Nifty, which rose on 3 out of 5 trading sessions and outperformed the Nifty in the bargain. Last week, I advocated that the price needed to trade above its 25-day exponential moving average, which is a very simple but a highly effective technique. I also said that the expanding triangle shown on your chart indicated higher beta or price volatility, which also occurred along expected lines. Now the bulls need to hold on to their gains and defend the last week's low in case of declines. Therefore, the 34,750 level approximately needs close watching. Now let's look at the weekly chart. A big strong bullish candle and the price staying above the 25-week exponential moving average tells me that the medium-term momentum also remains positive. Can the Bank Nifty test its previous all-time high? I think yes, but provided the bulls take it past the 36,500 levels above and then don't let it fall below this after the breakout occurs. One thing is certain, no matter what happens, volatility is likely to remain elevated, so we need to be cautious. In the week before last, this index was number 4 on the most volatile counters list, but it rose to number 3, which tells me that volatility has shot up. And the range I advocated last week between 35,950 on the upside and 33,200 on the downside was overcome on the upside because the weekly high was 36,220. The bulls are actually pushing the envelope. They're getting gung-ho, they're getting enthusiasm, which is why the range broke upwards. The coming week is likely to see an estimated, I stress upon the word estimated, range between 37,200 on the upside and 34,400 on the downside. I think, my friends, we should trade light even in the week going forward. Let's now take a look at the most liquid counter on the NSE derivative space, the Nifty 50, and note how the daily chart on your screen shows a breakout above the channel we had plotted last week. The price continued to remain above the 25-day exponential moving average, which confirms that the short-term outlook is also bullish. Now that the 15,900 hurdle, which I talked about last week, has been overcome, it will turn into a support on declines and the bulls must defend it on dips. Watch this 15,900 level carefully with a small leniency of about 50 points here and there. Note how the weekly chart, where the price is remaining above the 25-week exponential moving average, which means the medium-term outlook is also positive. The channel on the weekly chart is the same that I showed you last week, and I remember what I said, that after 7 weeks of consolidation or movement within the channel, when the breakout comes, it will be spectacular. I use the word spectacular. And it did. And how? Straight all-time high. And in the week before last, this index was number 24 on the most volatile list, but it jumped 17 notches, straight 17 notches to number 7 because volatility skyrocketed. So let's be careful out there. And last week I advocated a range between 16,175 on the upside and 15,350 on the downside, which was surpassed on the upside because the high exceeded this level, which again tells me that the bulls are gung-ho. And the coming week can see an estimated, I repeat the word estimated here, range between 16,675 on the upside and 15,825 on the downside. My friends, I think you should continue to trade light in view of the higher volatility. Now, the indices is done. Let's now come to the most popular segment of this video, where I'm going to give you 5 stocks which are high beta, high impetus. So you take small exposure, wait for big price moves, and 5 stocks which are low beta, low impetus, where you take big exposure, wait for small price moves. Different traders, different techniques, therefore different solutions. So high beta, high impetus stocks list is led by HDFC Limited at number 1. Number 2, surprise, surprise, Nifty 50, the index itself. Number 3, Eicher Motors. Number 4, Siemens. And number 5, Cummins India. The low beta, low impetus stocks is led by Jubilant Foods on the number 1. Number 2 is Apollo Hospital. Number 3, Glenmark Pharma. Number 4, Biocon. And number 5, Emphasis. Now do remember that this hierarchy can change day to day, hour to hour, because volatility is compressing and expanding. So do connect with me on social media. My contact coordinates follow. And friends, if you liked this video, please subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos that I put up out here in the comment section. Do keep all your feedback coming. Also, I'm associated with Equity Master, wherein I put a couple of video ideas every week. My hyperlink to my playlist on Equity Master follows in the description below this video. Also avail of a free trading guide from Equity Master. The hyperlink of that free trading guide is also in the description. Friends, this video done. My contact coordinates coming up on your screen. Thank you for your patience. I wish you have a very, very profitable day. Play safe, play wise, and keep your traded quantities small. Till we meet again in my next video, this is Vijay Bhambwani signing off for now. Do take very good care of yourself. Bye-bye.